Hello everybody, it's Tom Sheridan and Chris Darbyshire from 7 Investment Management. We've just had the Quarter 2 Asset Allocation Committee, and as is our wont, we're here to explain what happened during that and how it affects your portfolios. Now, before we do that, we should probably explain Roz Price has become the Chief Investment Strategist of 7IM, and she chairs the Asset Allocation Committee now, and Chris is joined as the Chief Investment Officer. Chris, tell us a little bit about yourself.
Yes, I've been with 7 Investment Management for a year. My background is in investment banking, where I worked for Goldman Sachs and BNP Paribas for many years. And before that, I was a finance director in the media industry.
Well, that's quite a background. And in 7IM, Chris is going to be particularly focused in the next year or two on the tactical decisions that we make. And indeed, that's exactly why we're here today, which is why we have Chris with us. So with no more of that, let's get on with the show. And wow, we've had a great first quarter. If I look at the different risk profiles and how they performed the first quarter, I'd almost want to shut down for the year and lock in my profits and go home, and I'll see you next January. Unfortunately, that's not the way the world works.
It's very tempting to do that. But actually, the economic environment is not that different from last quarter and the quarter before that, and we think the trends that we've seen in the market probably are going to continue.
But let's talk about the different asset classes first. Let's start with equities. A lot of people have said, well, they've had a great run. Is it far enough?
Equities have had a good run, but the valuations are still reasonable. So unlike the two previous highs, actually valuations are at or below long-term averages at the moment.
Maybe break that down geographically. Why don't we start right at home here in the UK? What's your view on the UK equity market in particular?
We're positive on the UK equity market. It's an equity market that is really very international in the types of companies within it. Indeed. In fact, 80% of the sales of the FTSE 100 companies come from outside the UK.
Right.
So it's really a global growth market. And global growth is probably at the lower end of its historic norms at the moment, but it's moving on up.
So even though you may not love the UK as an economy, you're okay with the UK as a stock market?
Very much so. So we're neutral in our UK allocation.
Let's look at the East a little bit, or the markets that you do like. I believe you've told me that you like Europe.
Well, we've liked Europe for a while, and it's been a controversial decision. We think that it's a very large market. It's the biggest economic market in the world, bigger than the US, talking about the Eurozone. And you very rarely get the opportunity to invest in something like this big liquid market at cheap valuations.
Right. How cheap is cheap, and why is it cheap?
The European markets are at about a 25-30% discount to the US market, for example. And this is an extremely low level relative.
Indeed. I mean, the core view of 7IM over the last 3 years has been built around the fact that we never thought that Europe was going to become an Armageddon scenario. Over the last year or so, some of the big risks seem to have faded a little bit. What's your view on what are the remaining risks?
Yes, that's right. We still have political risk in Europe. Can growth return before the electorates in some of the European countries get fed up enough with the slow growth and eject their politicians?
Well, aside from the comedians that we've installed in Italy, or almost installed in Italy, if there's no prospect for growth, why do we still like the market?
I think we think there is a prospect for growth. It may be a couple of years away, but what we've seen is the end of the world scenarios haven't really come about. We see the European Union and the 17 members of the Eurozone begin to see a pattern in the way they behave. It's a muddling through process, but that's not a bad thing when you have 17 voices to accommodate.
And the periphery of Europe, the southern Europe, or the so-called pigs, if you will, what's the current state of play in Spain, Portugal, Italy, Ireland, Greece.
At a very top level, GDP growth is not good, still negative. But actually underneath the surface, there's a lot of good things going on there.
What would they be? I mean, you've talked about structural reforms as being critical.
And structural reform is the key here. It's reform of the labour markets, reform of the trade unions, reform of the civil service. It's, in a nutshell, it's making these countries competitive.
So the challenge for Europe is to have enough reform of the labour markets while there is the pain to create the political will to create the reforms.
That is absolutely right.
Are they going to get to the point where they can actually compete with Asia?
Yes, in a word. I think ultimately all economies have to get to that level if they're going to remain competitive and if you're going to keep employment up. There are different ways to get there. Perhaps you can emphasize skills and technology such as Germany and Japan.
Yeah.
Or you can emphasize just low cost, which is where some of the southern European countries are going.
And I think indeed some of the motor companies have announced deals recently in Spain.
That's right. Ford is investing in Spain. In fact, it's closing plants in northern European countries and investing in Spain.
And is that because of the abundant cheap labor that's there now?
That's right. Spanish labor costs have come down a lot relative to northern European costs. And this is the process. This is the process of reform in action. It makes your exports cheaper and it makes your labor force cheaper so that you get more foreign investment.
Right. So how about other parts of Europe? If we like Germany, the structural reforms in the south seem to be coming through. How about Eastern Europe?
Eastern Europe we like. We think there's a good knock-on effect that will come there from improvement of the Eurozone and the European position. That should affect the economies on the fringes of Europe to the east.
And you mentioned, although we have valuation discounts in Europe, in the UK you said most of the sales activity is outside of the UK. Is that the same for Europe?
So for the big European blue chip index, the Eurostoxx 50, 50% of sales are from outside Europe.
Right. So we have another scenario where the global economy is really the question. We have currency overlays when we get to the UK versus Europe versus other parts of the world, but we are really dependent upon a global growth story. So if the global growth is not really going to come out of Europe, and it's not going to come out of the UK, where is it going to come from?
So the US is going to be the dominant factor in global growth, certainly over the short, medium term.
And how's that picture looking at the moment?
Picture's looking very good in the US. Several key parts of the economy have started to grow again. Housing's a good example.
Well, housing is what started all this mess, isn't it?
That's right. And housing got us into it, and we're hoping housing will get us out of it, in a sense. The housing market has rebounded very strongly in the US. It's a very affordable asset now for US homeowners. Long-term mortgage rates are really down to levels they haven't been at in 30, 40 years.
So as a buy, you like US property, do you?
Yes, we would love to get our hands on something. It's very hard for institutional investment type organisations such as ourselves to actually invest directly in US property. We've tended to go with commercial rather than residential.
Right, yeah. Now, the US is a bigger picture than property alone. One of the major stories has to be the energy picture in the States. Tell me about it.
It's a rapidly changing story. The US was a big consumer of oil in the early days. Then its reserves ran down. It had to import a lot. Now the discovery of shale gas and shale oil, which is a type of oil which is very abundant but quite expensive to get out of the ground. With high oil prices, these projects, these developments have become feasible.
So how much of what they used to import from the Middle East has now been not necessary? We think they'll be self-sufficient in oil, perhaps in about 10 years. That's unbelievable. I mean, if you look at where we've come from, that's a massive, massive change. If that turns out to be the case, That has to be a major investment theme.
I think shale oil is a real game changer. I think it's an investment theme in itself. It has implications for the energy companies, but it has much broader implications, particularly for the US economy, because it keeps energy costs down. That's good for the consumer. It's good for inflation, and it's good for companies that use energy to manufacture products.
Right. So if the housing picture is gradually getting a little bit better, bouncing off the bottom, shall we say, if we have a major change over the medium term in the energy supply, that also has implications, of course, for political risk in the States. One of the big issues holding the recovery back has been the ability for banking systems to lend. Talk to me about the States.
So the US got to grips with its banking system, with its banking crisis very early into the credit crunch. And as a result of that, and after serious write-downs of assets, the US banking system is now in a pretty healthy position. Its capitalization ratios, so the amount of safety, the safety margin, if you like, for bank investors are high. The banks are lending again. They are flush with cash, very keen to pay dividends.
Right, so we've got a different scenario in the banking community in the States versus the UK and Europe then.
Very much, and that's one important part of economic growth, is the credit, availability of credit via banks.
So is it fair to say that although the US went into the downturn first, it looks like they're coming out of it first as well?
I think that's right. I think there will be constraints on government expenditure in the US for years to come, but the private sector is doing pretty well.
Right. And the currency implications for all of that?
The currency implications are really strong dollar. The dollar's actually been on a depreciating trend for 20 or 30 years now. And we think that's going to change, and we think that although it's a long-term view, the dollar will begin now to appreciate again as the economy there gets stronger.
And indeed, versus sterling, it's gone from about 160 to 150, 51 over the last couple of months already.
It's been a very big change in a very short space of time versus sterling, and we've been largely exposed to that change. It's been good for the portfolios over the last few months, and we think that's going to continue.
Now, many people, most commentators would say that the real engine of growth in the world is going to be the East. We've had this massive shift from economic activity from the West to the East. Let's talk a little bit about Asia. You've told me many times that actually Japan is an interesting place at the moment. I've been listening for 20 years for people telling me every January Japan has got to be the place to be, and for 20 years it's not been the place to be. What's different?
So there have been many false dawns in Japan, it's true. This time the new Prime Minister Abe, has a significant majority in the lower house of Parliament and is very likely to get a majority in the upper house as well. And this gives him relatively good control over policy.
That's a major difference versus the rest of the world. I mean, in the States, we have the Republicans and the Democrats arguing with each other. Over here, we've got a coalition government. In Europe, we've got 17 different democracies trying to agree anything at all. And what you're telling me is in Japan, we have a political majority and the central bank on side?
And the central bank on side with new management. And a will to change policy and a will to escape the deflationary problems that Japan has had. And very specifically targeting a weak currency, which is obviously going to be very, very good for Japanese exporters.
A major, major shift there as well. So we're looking at big themes here. We're looking at the energy picture in the States. We're looking at the political scenario in Japan actually adopting policies, finally, after 20 years, to try to break that deflationary cycle. That could be another major event in the world.
I think that's right. Compared to this time last year, we have several very big and very positive themes to consider. We still have some big negative ones, but it's not now dominated by negative themes.
Right. How about the rest of Asia?
The rest of Asia, we obviously have to keep an eye on China.
That small little country there with about 1 billion people?
Exactly. I mean, it's a big component of any emerging market position. And I think it's an important asset in terms of sentiment.
You've got concerns over China. Tell our investors about your concerns.
Well, my issue with China is that you've got very poor transparency. Got not just a command economy, but it's really a command market. You know, that the government can pull levers to make things happen, and we feel that's a very asymmetric situation. We have no knowledge and no control.
Asymmetric situation. What's one of those?
So the government there has all the power, all the control, and holds all the cards.
Right. Okay, so it's not very transparent.
Exactly.
Rightio. But we talked before about investing in the UK equities or the US equities or European equities, these multinational companies. China, although we may not want to invest in the Chinese market, becomes a very important piece of the equation of global growth. So do you still believe the growth story?
Yes, I think China is a worry. New government in place, new policies are possible. Growth is at the slower end of expectations there at the moment. But at the slow end in China, it means 7% GDP growth per annum, versus our 1%.
Right. And 7% growth in China is actually a substantial contributor to world GDP growth now, isn't it? Because the base of the economy has gotten larger.
So that's right. Even at the lower end of growth expectations, China, together with America coming through, the global world economic growth situation looks reasonable.
All right. So we wouldn't want to be investing necessarily in Chinese equities, but China as a source of growth for the world, we're okay with this story, even if it's at the lower end of expectations. Emerging markets. What do you think of emerging markets these days? And indeed, what are they anymore?
Well, it's hard really to say. I think how emerging markets and frontier markets and the like are defined is perhaps it's maybe time to change those criteria. Emerging markets are, for us, politically developed, good rule of law, some corruption, but certainly not excessive. Whereas a frontier market for us is really the opposite, political risk.
Who are the frontier markets?
So the frontier markets would be Middle Eastern countries, African countries, most prominently Nigeria.
Do you own them?
Yes, we do. We own them through Templeton Emerging Market Frontier Markets Fund, which we like the manager there very much. And it's a very diversified portfolio of very cheap countries that bear some risk, but have excellent prospects.
Right. So not so keen on some of the emerging markets, keener on the frontier and the developed markets with exposure to world growth. The picture is beginning to get a little clearer here. Let's talk a little bit about fixed interest for the moment. Everybody in the world knows now that gilts are going to be a horrible thing to invest in for the rest of eternity, or so it seems. We've got 10-year yields at 200-year lows. As an investment manager looking after our clients' retirement money, we normally give a cautious client a lot of gilts. So how do we face the prospects for the gilt market and still provide for the needs of our conservative clients?
Step one is to deal with the immediate problem, which is gilt valuations. As you say, the yields are very, very low, therefore valuations are very, very high. And we are progressively reducing our exposure to gilts. We don't think it's going to happen. We don't think there's going to be a surge in yields overnight. The conditions that caused gilt yields to fall to the current levels are still in place.
And they are?
Bank of England buying of bonds, so QE is the main one.
So we've artificially depressed the gilt yields, and this is something we've been talking about for 2 years now. If we're not buying gilts or we're shortening the maturities on the gilts that we have, within the fixed income asset class, we can't just abandon the asset class because we need it for the diversification of the portfolio. What are we doing other than gilts in fixed interest?
So one thing we're doing is we're moving our exposure from the UK, the US, so more developed but still highly indebted markets, to markets which maybe have similar characteristics but offer much higher yields. In other words, where the risk is priced in and we get a better price.
Such as?
Italy, Italian bonds, Spanish bonds, not long duration, but we think they at 4% yields, that's double what you get in the UK.
Right. So the periphery of Europe, going back to the 7IM view that it's not going to all fall in a heap, can manifest itself now in our fixed income allocations. How about other parts of the world? How about emerging markets? How about high yield? How about what else do we do in fixed income?
Yes, so US high yield has been a very good asset class for us over the last year or so. Although returns are coming down, they still look pretty decent compared to government bonds, so we're sticking with that position. Emerging market bonds and corporate bonds, these are areas where you've still got quite attractive returns, so we're going to prioritise them over sovereign debt in the more developed markets.
So a clear picture of what's going on with equities, a clearer picture of what's going on in fixed interest. Alternatives is always featured largely in the 7IM portfolios. A little less so lately. Talk to me about that.
The hedge funds that we did hold, their performance post-credit crunch has been, again, somewhat lackluster. The market conditions that they need to really do their job to the best of their ability haven't really surfaced yet.
Right. So you've gotten rid of the hedge funds, you've gotten rid of the CTAs, metals, not least because they don't have a yield on them. We've not been so keen on the metals. Talk to me a little bit about the gold position and then property.
So the gold position, gold is an asset you hold if you think the end of the world is coming, and or if you think that the QE that we've got in place is going to cause a rapid currency devaluation and some form of inflation. We think both those risks have gone away somewhat, and therefore the argument for holding gold has really reduced.
So we've diminished the position of gold in the portfolios. It's not completely gone yet, though, is it?
Not completely gone yet.
Okay, but on its way.
Indeed.
All right, property.
So property, we've want to avoid UK property, where we think the very prime part of the property market is probably at a very high valuation, doesn't really justify the risk.
What do you like?
We like US commercial property, as I mentioned. We're accessing that through REITs.
Okay.
And we're accessing property as well in other regions of the world.
Which ones?
So that would be some European and some Asian mainly.
Okay. So in the alternatives, we've gotten rid of the CTAs, hedge funds. We've got some extra property in there, reduced gold a little bit. So the overall allocation to the alternative section is decreased right now. We're primarily focused on equities really as the engine of growth in the portfolios to come. There's been one big omission in this discussion so far, and that is the role of currencies. Currencies have, from time to time over the past couple of years, been the dominant mover in the portfolios. What's the current view?
That's right. Currencies had been fairly dormant over the past few years since the credit crunch, and then just recently we've had a couple of big moves. Sterling down has been the main move for us. So we've been really very exposed to the dollar over the past 3 to 6 months, and we've enjoyed a good run. Sterling has come down from 160 to 150. The euro, similarly, euro against the dollar has been strong, and we've maintained good exposure to that position as well. You think going forward, sterling will trade significantly lower against the dollar. We think the trading range is probably going to take a big step down.
Right. So we still like the dollar. We still got a bit of euro. We're still hedged on the yen. And we have exposure to emerging market currencies largely through our fixed interest. That's a pretty comprehensive view of what's going on in the world. That is a lot of work for you and the committee. And it's very, very important to our investors that they know that we're working very, very hard, particularly in a challenging world, to protect the conservative investors that we have. Chris, thanks very much.
Thank you.